Hello, I'm Rabail Chandio. I'm an assistant professor and extension economist here at Iowa State University. And today we'll talk about farmland values and how they're evolving in the current conditions in the current market. Why do we care about farmland? Well, as most of you would know, farmland itself makes up more than 80% of the assets on your balance sheet. It's the biggest item that you'll ever buy. It's the most expensive thing that'll show up in your books. And we do tend to keep an eye on what's happening with its value because it tells us about the health of the farm sector overall. So, what's been happening with the farm sector and the farmland values? This past year, we saw a decline in the statewide land values for Iowa. They decreased by about 3.1% or $369 per acre, bringing us to an average value of $11,467 per acre. Now, this was the first decline after 5 consecutive increases that we experienced in the previous few years. So as we see on this chart over here, we are coming off of a very big peak that we experienced during the pandemic during the last few years. And here the red line shows us the nominal values, the number, the ticker price that you see everywhere. And the blue line shows us the inflation adjusted values of farmland over the last more than 50, 60 years. We see that the nominal values fell by 3.1%. That's what we saw before. But if we account for inflation, the values fell a little bit more, decreasing by about 5.5% and settling at $8,627 an acre. Now, if we map how this change looks year over year, it's the same chart, same time period as we saw in the previous slide. But here, the red and green bars show the year over year change instead of the total final value that we end up with. So we see these are the 5 consecutive increases that I mentioned. Before the very last red bar that goes below zero, we have 5 green bars that are going quite high up, a lot more than 5-10% that we're used to seeing. So when we experience a peak like that, it's generally going to be followed by a downfall and an adjustment after that. I would like you to compare it to the previous few years where we saw the red. The last time we saw those red dips in farmland values or decreases in farmland values were right after we were coming off the ethanol boom. So ethanol boom picked us up in terms of the ag income that helped us have very high land values that led to an eventual decrease. That is more of a minor decrease, a market adjustment, nowhere near the other set of the chart where we see a lot of red bars during the 80s, during the farm crisis. That is not at all what we're comparing this period to. We're comparing it to the 2014, 15, 16 red dips that we see at the near end of the chart. So this first decrease after 5 years is sort of bringing us towards that market adjustment phase a little bit again. And we saw quite drastic surges in land values, around 29%, then 17% during the pandemic. So this offset of 3.1% is not at all enough to go against any of that increase in our asset, in our farmland. If anything, if we compare the county level values, none of the Iowa counties' values fell below the 2021 levels. So we haven't at all outdone the peaks that we gained during the pandemic. Now, that was the state level trend. What's happening around the state? What's happening a little bit more regionally? This chart shows us how the crop reporting districts are performing. There are 4 values on there, then a percentage next to it. So the 4 values, the top 3 values shows you how the weighted average value for high quality land, medium quality land, and low quality land within that crop reporting district stands. Where does that stand? The per acre value. The number in the middle shows us what the average value within that crop reporting district is. And then the percentage change at the bottom puts all that together and tells us where we're moving compared to last year. So 8 out of all 9 crop reporting districts in Iowa this year experienced a fall in land values. The only exception to that is South Central. You'll see it on the bottom of the screen, which experienced an increase of 3.6% in land values at the crop reporting district level. Now let's see the breakdown of these changes by land quality classes. First of all, the district to experience the biggest decline this year is West Central, and then it's followed by Northwest and North Central. Some of the Northwest and north part of the state is where we're seeing the biggest decreases this year. And they're distributed quite evenly across the three land quality classes. Then, if we take a look at the next columns, the high quality land value, the change in high quality land value, the medium quality land value, its change, and then the last two columns corresponding to low quality value per acre and the change in that quality class. So we see that if we go to the row with West Central, there the overall decrease is 7.4%, and it's matched pretty evenly in all three columns. The high quality land in that district fell by 7.1%, the medium quality fell by 7.7%, and then the low quality fell by 11.5%. So overall, this year the change is coming from the changes in broader ag economy, changes from our farm income, the support taken off, and we'll look at all of these factors in just a little bit. So that's why we're not really seeing the changes differently across each quality class, because the broader economic factors are affecting the overall farmland markets quite evenly. Now, if we look at South Central, that's the only line here in green, because that's the only district to experience an increase. We see that a lot of that is coming from high and medium quality, and not as much from low quality. And we'll talk about South Central a little bit more later as well. But here I'd like to mention that the reason we experience a little bit of a different trend in the southern part of the state sometimes is where the demand for that land comes from. Sometimes demand for recreational ground, for hunting ground, some of that investor activity in terms of investment in the recreational or hunting grounds, that is also driving the market in some parts of the state over here in the southern part. And that's a major reason why this part seems to experience smaller declines and then in some cases increases here as well. The other reason why the South seems to experience or have a better year in terms of land markets or land values is note the overall value. The land value itself per acre is much lower compared to the northern part. And if we look at the trends in the last 2-3 years, they did not experience those surges that some of the northern counties did. The northwest part of the states, where we saw those $30,000 in acre sale, those $27,000 in acre sale, and they were not a single occurrence. There were multiple occurrences of those examples. The South did not experience those. So, since we did not have very drastic increases, we're not experiencing any drastic decreases over there as well. It remained pretty much stable through that market high. Now, whenever land values change, cash rents tend to follow. It takes about a year or 2 years of lag, but you'll note that this is also a first year after a few years where our cash rents are not increasing. So land values fell just a little bit, just by 3%, not a drastic number at the state level. And then some parts of the state experienced increases, some decreases. In most cases, they were still minor decreases. And if we match those districts up with these cash trends over here, that story would somewhat follow. Overall, it's pretty much the same. But for some districts in there, for District 4, let's say, the cash rent last year was $298 per acre. Now it's $297. Just a minor move in the other direction. For District 7, it was $265. Now it's $263. For District 9, it was $252. Now it's $247. So there's just a little bit more leveling off in cash rents as well, which may actually move in the opposite direction following the land markets with a little bit of lag. But overall, we're also seeing that trend being followed in the cash rents. Now, why does that trend follow in cash rents, and why do we talk about it? All of you would be aware of that. There's something that we call cap rate, which is essentially the rent to value ratio. That's a very quick way for us to figure out what is our return on investment from land. So you buy land, which is $10,000 an acre, and you get the return of $250 per acre in terms of cash rents. That gives you a cap rate of 2.5%. That's the money you're making on that land. So there are a few different things I'd like to highlight on this slide. First, note that the rent to value ratio does not change as drastically as our land values did. It's not going up and down from year to year, even within the years when we had those booms or when we had those falls. telling us that this ratio remains pretty much stable in the short run. If land values go up, cash rents will follow. If land values go down, cash rents will follow, keeping us around the same number for the rent to value ratio. That's the first thing. Now, the second thing, compare it to the other two lines on the chart that we have here. The red line measures the real farmland loan rate. That's our cost of borrowing on the land. So if you're earning 2.5% return, how much are you paying the bank? So generally, that should be a little higher than what you're paying. Your return on land, you would want it to be higher than what you're paying, but it would be pretty much about the same. Because if interest rates increase or the cost of borrowing increases, we will adjust that in our market, bring it back to a constant profit rate, change our rent to value ratios. Then the third line on there is the CMT 10-year rate. Now, why is that on there? We'll talk about that later as well. But a quick preview, we call farmland the safest investment there is. It's not going anywhere, it's not risky. Everybody hopes that it will appreciate if we zoom out enough, if we wait enough years. Another very safe investment is the US Treasury bill. So if we take the average return for those investments over 10 years, that's the safest investment we can compare our quite safe asset, farmland, to. So that's why we also map the CMT 10-year return in order to see how is that safe investment performing. And over time, we see that the farmland markets or the rent to value ratio moves in tandem with the CMT 10-year rate. And this is also the direction where the real farmland loan rate moves. These are the ways for us to figure out what will happen in the next 2-3 years. These are not the ratios that are going to oscillate a lot, giving us an expectation that we'll stay within this relationship a little bit more as well. Now, why has the rent to value ratio declined over time? One more thing you would have noticed in that graph previously is that it's downward sloping. We had the rent to value ratio as high as 6, 7, 8% earlier, but these days it's around 2%, 2.5%, and in some areas, if you're getting higher rents, it would go up to 3%. There is not many places in Iowa, I would expect there is none, where the cap rate would exceed the 5-6% mark. So there are two reasons why we have moved to a period of lower rent to value ratios and seem to stay around there. The first is that prospects for appreciation in land value are often bid into the purchase prices, but they're not bid into the cash rents. When we buy land, we're expecting it will give us an income from two sources. It will give us a direct income from cash rents, and then it will also give us capital gains. Since people who are buying land, both farmers and investors, are happy to experience returns from both of these sources to maintain the overall positive cash flow or maintain the overall profit on the investment, the cash rent as an individual source of income do not need to exceed the cost a lot more. You're going to bid a lot more in an auction just because you know you can sell the land for higher 10 years, 20 years from now. So it's not just about how much cash rent you can get on the land, it's also about how much you'll sell it for later. That prospect for appreciation decreases the rent to value ratio. The second reason that interest rates have been low recently relates directly to the pandemic period and what our return on all the investments were. So the interest rates fell quite a lot during the pandemic. That was the cost that people had to pay when they borrowed to invest in anything at all. And in order to make a profit, they just needed a little bit over that cost of borrowing. They just needed to make a little bit more than what they were paying the bank. So investors were happy to accept lower returns on a number of different investments. And farmland competes with those investments. So that lower cost of borrowing, that lower cost of investment leads people to accept a lower percentage return. And that phenomena has been true overall as well. So interest rates these days, we call 5% federal fund rates quite high. But that, if you go back 20 years, 30 years, the 5% interest rate would not be classified as something that's high. So overall, the cost of borrowing has also moved in that direction. It hasn't really moved in an upward direction. These factors tighten up our rent to value ratio, making it settle around 2 to 3% that we have these days. And interestingly, that's where investors and experts in the land market expect it to stay. This chart shows the expectations from professionals in the agricultural markets that we collect at the Soil Management and Land Valuation Conference that's run every year in May at Iowa State University. And these professionals give their expectations of what the cash rents are going to be within their regions, and then what the land values are going to be within their regions. And then we compute the average for Iowa as well. So, based on their rent expectations and their land value expectations, we compute the rent to value ratio, the cap rate. And it's interesting to note that in May of 2024, folks expected the cap rate in November, that's the survey data that we just showed, to stay around 2.6% at the state level. And then 1 year from then, 2 years from then, 5, 6 years from then, in 2030, and then almost 15 years from then, in 2040, people expect cap rates to remain pretty much the same. Now, we'll see that as well, that a lot of people, that's not at all an unusual thing. People expect land values to rise. People expect cash rents to rise as well. But the ratio is expected to remain quite stable over here. Now, 6 months ahead of time, people are predicting a cap rate of 2.61%. And I'll tell you, based on the numbers that we got from the December survey, land value survey of this year, of 2024, that the actual cap rate ended up being 2.47%. So it was quite close. The experts were not off their mark, and that's also the reason that we expect that they will remain pretty much on that mark, because they are the people who are advising clients on how much to pay for certain lands, on how much cash rents to accept. So this is a new normal that seems to be prevalent in the Iowa land markets now. Now we have our survey, but we also like to take account of what others around us are saying when it comes to the direction of the land markets. One of the surveys that we like to refer to is provided by the Federal Reserve Bank of Chicago. Their Ag Letter Survey measures the percentage change in the value of good farmland in Illinois, Indiana, Iowa, Wisconsin, and the overall 7th district formed by all these states. And they also find a negative direction or a slight decrease in the Iowa land markets. Their decrease from October 1st, 2023 to October 1st, 2024 is expected to be around 1%. That's a little lower than our number, but it's the direction that we're interested in comparing to. For Illinois and Indiana, the other corn states, the other Midwestern corn belt regions that we like to keep an eye on, are also experiencing similar directions when it comes to their land markets, with Indiana experiencing or reporting a 2% decline in statewide values and Illinois reporting a 1% decline. Now, on this chart, there's also Wisconsin. Wisconsin seems to be moving in a different direction. That's the only state over here, if we look at the annual change in land values, that still reports a rise in state level land values of about 4%. There are two factors. One, they're only focusing on the good quality farmland. This is not a statewide value of all the farmland that's there. But then there's also a second reason. And I'd like you to think for a second, what is Wisconsin known for? It's the dairy state. If we're moving away from the crop sector, the story might be a little bit different. Now, the other survey that we'll look at is the Federal Reserve Bank of Kansas City's Ag Credit Survey. They also report a 5% increase in land values from previous year, and that's their non-irrigated value that I'm focusing on. And on a side note, also note that the cash rents seem to follow the same trend. That's what we expect in Iowa as well, around everywhere. But yeah, let's get back to land values. So they also experience or report a 5% increase in land values. So Wisconsin and Kansas, the reason that they're experiencing an increase while some of these other states that we looked at did not report that sort of result is because they have something else on top of the crop markets that forms up a large portion of the state. In fact, in the Ag Credit Survey, they explicitly mention that areas that were more concentrated in crop production experienced a decline in net income, which is something that gives value to the land. But it's areas in livestock and other cattle related production operations that are helping sustain some of the land values in both Wisconsin and then in Kansas as well. Another Iowa specific survey that we like to keep an eye on is done by the Realtors Land Institute. And their survey measures the change in land values from September of one year to the other. So from 2023 to 2024, they report a decline of 8.1% in land values. That's a little bit higher than our 3.1% for two reasons. One, we like it despite the change in magnitude because these surveys are most reliable in terms of measuring the direction, not the exact minor change in land values. So they are reporting a decline. We are reporting a decline. Illinois, the Federal Reserve Bank of Chicago, is also finding a decline. That gives us confidence in the data that we're getting. The second number, the second difference also comes from who is responding to these surveys. The Realtors Land Institute, their survey is responded by a lot of realtors, ag experts, the auctioneers, brokers, not a lot of farm managers, not a lot of bankers. But the Federal Reserve Bank of Chicago, their survey, and then the Iowa State survey, a large portion of the respondents is formed by bankers and then government professionals. So when banks are lending, banks are interested in the amount of land against which they have to give a loan. When realtors are measuring this here, they're also accounting for a lot of cash transactions that may be taking place for which there's not a lot of borrowing happening. So there may be a dichotomy between where this data is coming from versus where the other data is coming from. Despite the differences in the data sources and the respondents, it's interesting to note that the Iowa land market is moving in a decidedly downward direction. We've been touching on the things that give value to land or how land values in certain areas may be rising and falling in the others. Let's bring it all together by understanding the framework from which land values are determined. Land values can roughly be understood by this equation that's on the slides right now. It's a fraction of localized net income divided by the universal interest rate. There are a few different things that I want to tackle here. First, why is the localized and the universal highlighted or in a different color? And why is there localized next to the net income while next to the interest rate I put the universal on there? First of all, net income comes from a specific farm. It can vary from one operation to another. And when you are considering whether to buy plot A versus plot B, you're not really concerned with what's happening with the USDA net income forecast. You're really concerned about the yields on that specific plot. You're really concerned about the income potential of that specific investment. We think of land as an investment. So the return from that specific investment is what you really care about when determining whether that's a good investment that you'd like to make or not. So when it comes to net income, the buyer is focused on the localized net income for that operation. But when you want to think about how that net income will be discounted over time, how that will change value over time, the economic pressure the economic pressure that gives us the cost of borrowing that is not determined by one person individually, that is true and equally the same for everybody coming from the Fed Reserve, is not something one person has control over. That's an economic signal. That's a universal economic farm economy direction that no one person has control over. So when we think about net income, we're focused on the income potential of a localized specific farm. When we're thinking about how that net income will be discounted over time, the interest rate that's discounting it is coming from the overall economy, and we don't really have any control over it. That's why land values are going to be determined by the localized net income for that specific farm and the universal interest rate. That's true for everybody. Some of the factors that generally have been reported every year to affect land values include interest rates, commodity prices, land supply, and then yields. Let's look at which factors were very important in the market in 2024. So, what were the major positive factors affecting Iowa farmland markets in 2024, as suggested by our respondents in the survey? The biggest factor that our respondents mentioned was the limited availability of land or limited supply. And I'm an economist, and whenever you talk to an economist, they'll bring you back to demand and supply. The value of everything is determined by what the demand for it is versus what the supply for it is. For land, this year the supply was less. There was less land available for sale on the market. That helped us go from a 3.1% decline to a much deeper decline. This positive factors, including the land supply, is not really increasing values in 2024. It's keeping values from being further lower than they already are. So the biggest factor that was reported was the limited availability of land. After that, we also have strong yields. Then we have cash and credit availability, strong demand, including demand from farmers as well as investor demand. And then a few people also mentioned favorable interest rates and good farm economy. When it comes to favorable interest rates, we don't have amazing interest rates at the moment, but if you borrowed a couple of years ago at a fixed rate, those people are still going to find the interest rates favorable when it comes to the land market. Let's look at some of these factors in a little bit more detail. If we try to figure out whether the land supply is more or less compared to last year, 56% of our respondents mentioned or reported that they have fewer sales within their counties this year compared to the same time last year. This is the limited supply that I'm talking about. Not as much land is available on the market, so whatever becomes available has enough demand to match its value or to keep its value strong. Then the second factor on our chart was yields. So corn yields for the United States ended up at 179.3 bushels per acre. For Iowa, they're 211 bushels per acre, which is a 5% increase from last year. So our yields are higher. We see the similar trend for soybeans. Iowa is not the highest, but it's still among the very high states with relatively quite high yields. And then it's still increasing compared to last year. When it comes to yields, higher yields increase our income. That's a direct effect because we can sell more, we can make more income. But then I also like to highlight one more phenomena when it comes to yields. High yields benefit us most when they're higher than others. It's a relative, again, it's a demand and supply thing. If the yields for the entire country are overall very, very high, we flood the market with a high supply. It drives down the price. So the income, the revenue that each person, each farmer gets is going to be maybe lower, maybe about the same. So the yields generally benefit us most when our yields are higher than our neighbors, and in this case, I mean our neighboring states. So for Iowa, the reason that strong yields help support the market is because they help us make more money than some of the other states are able to make by their farming operations. That makes farming corn and soybeans here more profitable, more revenue driven, or more uh, return giving than other states. So that's why it helps us support the net income in that equation that we saw a couple of slides ago. Now, this chart shows the overall receipts, bringing together the cash receipts from those high yields, as well as including the commodity prices. And I've put this here in the positive factors rather than the negative, despite the fact that this is a year where we're experiencing a decline in our overall commodity receipts, as well as crop receipts, as well as overall net farm income. The reason I put it in the positive factors, despite the downward direction, is evident by that red box that I've drawn around it. Note that although we're in a downward direction, we're still quite above the pre pandemic levels. We stand above where we start from in that red block, in that red box, that is above 2019 and 2020 period. So even though our crop receipts are falling, they are still at par with or better than pre-pandemic levels. So cash receipts for farm sector are struggling. They're lower. Again, our farmland values this year are lower compared to last, but compared to the pre-pandemic levels, we're still in a relatively good place. And This is another chart to show the difference between different sectors. When we mentioned Wisconsin and Kansas earlier in some of those other surveys and talked about livestock or cattle sector helping the demand for land or helping the income from land in those states, this is shown by the charts over here. On the left hand side, with the blue bars, we have the US cash receipts for crops. And then on the right hand side, in the orange and yellow, we have the cash receipts for animals and related products. The cash receipts for cattle and calves, for dairy products and milk, for broilers, hogs, eggs, all of these categories are higher than last year. The orange line is 2024 projections, the yellow line is the numbers for 2023. So on the right hand side, we see that the animal sector is doing a little bit better compared to last year. Granted, there are pressures from the cost side, but at the very least, the receipts are increasing. If we look at the left side, go to the blue chart now, and compare the same trend in crops, most of the light blue lines, which are the projections for 2024, are less than the dark blue lines, which are the numbers for 2023, showing us this phenomena that states or areas concentrated in crop production are experiencing more tighter margins, lower incomes compared to the areas that are concentrated in the animal sector. Now, there's another source where our income came from and comes from every year. That is the government payments. While we have lower crop receipts, we still, that wouldn't have been as much of a downward pressure on it if we had made that up in terms of government payments. During the pandemic, we received record high government payments. If you see on this chart, these are the red parts in the 2020 2021 years, and then some non USDA pandemic assistance added on top of that. These are the orange portions in these two bars that really made up more than half of the government payments that the farm sector received or the farm producers received in these 2 years. Now, farmers are smart. Whenever there's a peak, people know that it's going to be followed by a downturn, it's going to be followed by a tough time. That's not at all a unique phenomenon that happens in every cycle. So when we had these amazing years in terms of our incomes, cash receipts, let's go back to this chart. This is the peak in the red block in the middle. And then we also had really a strong influx of cash coming from the government payments. All of these together bring us up very high when it comes to cash and credit availability. And this cash and credit availability is what really supported the farmland markets in these 2 years, gave us those peaks that made records in the farmland markets. But people are smart. They held on to that cash. They did not really spend all of it just yet or within those 2 years. That is why even 3 years in the third year where the support has typically or completely vanished almost from these charts. Look at the 2024 bar. There's no red, no orange over there. Despite the fact that we are in that condition, people are still citing strong cash and credit availability as a major positive factor supporting the land markets. And it comes from saving up that cash that was built up during the pandemic. Now, overall, these are the net farm incomes on the left hand side, and then off farm income, median farm income, and then total income of US farm sector households on the right hand side. Most of you also know that farm sector generally also experiences one of the people in the household working off farm and earning that off farm income. So one of the things that supported the farm sector or has been good for us is that the off farm income is also increasing over time. That's the middle set of bars in there. And then the median total income, including the farm income, including the off farm income, has also experienced a positive directional change in 2024. So the overall income to the farm sector, coming from all the sources, has been on the rise in 2024. Now let's get to the left-hand side, the overall net farm income, net cash income. Here, I just want to highlight the same point again. We are in a downward direction, but for both net cash farm income, that's the yellow line, and then the net farm income, that's the blue line, we are above the 20-year average. We are above the pre-pandemic levels. So we are in a downward direction, but we have not outdone all of the gains that we experienced during the pandemic. Now, we also talked about farmland being a safe investment when we were talking about the rent to value ratios. Why would investors buy farmland? It's not just a emotional thing that we think about farmland being safe. There's quantifiable evidence. So, Michael Engemeyer at Purdue University was part of this study where they calculated the beta. Beta is the risk of an individual investment compared to investing in stocks. And they compared the beta of farmland and different investments in a portfolio. So if the beta is of 1, it gets the value 1, that implies that an investment is just as risky as putting your money in the S&P 500 index. If the beta is higher than that for a given investment, it would be more risky compared to investing in the S&P 500 stocks. If the beta is less than 1, it would make an investment less risky compared to S&P 500. For farmland, they had farmland in Indiana as an investment measure. They also had individual farms in Kansas to compare. And for both of those investments, they found that the beta stands at zero point 0.1 or 0.06, much less than 1. So that's why in over time we've also developed this interest from investors into the farmland. That strong investment demand, strong demand to make farmland part of a well diversified portfolio from investors is also something that's been supporting the farmland markets. And it comes from this phenomena that it's very safe, and that fact has been realized by people outside the farm economy as well. Now, that may not be a very prevalent feature in Iowa. We really restrict institutional investment in land. But for Indiana and Illinois, those two factors really help drive the land markets to some extent. If we compare our investment in farmland to our investment in the stock market, let's see what that does. So, this study shows that if you put $1,000 in the farmland markets in 1950, it means you bought land worth $1,000 in 1950, versus if you put that $1,000 in the S&P 500 stock in 1950, what would it be worth today? The orange line corresponds to the farmland value. The green line corresponds to the S&P stock value. For the orange line, note that it's not necessarily doing worse off compared to the stock markets. A lot of people also mention that farmland is safe, but it doesn't return as much yield. It doesn't give us as much return on the investment. According to this study, if you zoom out enough, if you invested in the farmland and let it sit for long enough, it's going to be quite well compared to the stock market. Except for the last couple of years where the stock markets experienced that crazy peak, maybe a little bit earlier than the farmland markets did, we note that we're moving quite in tandem with the S&P 500. If anything, the ethanol boom in the post 2010 period actually made farmland give a higher return if you took your money out during that time compared to the stock market. Now, if you remain invested for a shorter period, let's say you put the same $1,000, but you invested that in 2010 instead of starting in 1950, then two things. First, it wouldn't increase in value as much. Of course, we need to let the investment saturate as well, let it appreciate as well. And then it's not doing as well compared to the stock markets. In the zoomed in period, in these 12 years, farmland is relatively much more noticeably lower than the stock markets in the S&P 500. So investment in farmland seems to be doing as well as stock markets only if you let the money stay in there long enough and essentially invest and forget about it. Don't think about using that money 10 years from now or 20 years from now. Now, these were the things supporting the land markets, but what are the things that actually pushed it into the negative direction? Let's look at the major negative factors affecting Iowa farmland markets in 2024. The biggest factor our respondents reported was lower commodity prices. The second biggest factor they reported was the long-term interest rates being higher. Then there was also the mention of higher input costs, and a few other notable mentioned things were lowering cash and credit availability. We can't keep using those built up cash reserves forever. They're going to run out sometime. then struggles with weather, the overall inflation in the economy, and the uncertainty when it comes to the ag sector. Let's look at the first couple of factors in a little bit more detail. Commodity prices also peaked during the pandemic. That's what gave us very, very high cash receipts, and they're coming down as well. So, those lowering commodity prices decrease the numerator in the equation in the fraction that we saw. When the net income falls, it puts a downward pressure on our land values. I put this chart over here, this chart that shows the trend over time, to highlight the thing I've mentioned maybe twice or thrice already. We are in a period of low commodity prices, but compare it to the pre pandemic. We are almost at par with the prices we had before the pandemic. A lot of the pressure is not coming just from the prices, it's also coming from the cost. So while our prices are pretty much there where we began before all of these hikes, it's the pressure from the cost sides that has some people more worried than others. For soybeans as well, it's a similar trend. The January VASTI estimate brings us at 1020 per bushel, and these numbers are again higher than the 2019 2020 values before the pandemic. So our prices are falling, but we still have higher prices compared to the pre pandemic level. And what's making our margins tighter? That pressure is coming more from the costs than just the prices, because the peaks are not sustainable. We were going to come down, and it's a good thing that we're still higher or above the pre pandemic levels. Now, when it comes to the interest rate, that also directly affects the land values, because you remember it from that equation: land value equals net income, localized net income, divided by the universal interest rate. This is that interest rate. And I've put a circle at the very end to show the very recent dips in interest rates. The Federal Reserve Bank announced a slight decline in the interest rates at the end of 2024 of about a percentage point, and that small decline is not enough to offset that hike that we see from 2022 to 2024. That hike of about going from 0 to 5% within 12 to 16 months during that short time period is still putting a strong negative pressure on the land markets. Interest rates take a while to affect the land markets fully. They affect us with a lag, and then they can take up to 2, 3, 4, 5, all the way up to 10 years to be fully capitalized in the land markets. So the small recent decreases are not enough to offset the hikes that began in 2022 and then went all the way in 2023. So those hikes are still the major factors putting a downward pressure on land values. And if we have to offset that, we need to see much more bigger decreases than the 1% that was announced last year, which is not on the expectation or on the horizon just yet. We're not expecting to decline, a very drastic decline in interest rates in the year coming forward. One more reason that the interest rate does not directly and very quickly affect the land markets in Iowa is because 84% of Iowa land is owned debt free. That tells us not a lot of people may need to borrow to buy land. That also speaks to the cash and credit availability we noted earlier. And then the only groups that probably feel the worst effect of that high interest rate are beginning farmers, are people borrowing to buy farmland and get started. And probably it's their decision that's going to be maybe delayed a little bit, or they're going to have to choose properties with a higher return than what some of the other investors or people or farmers in the land market can afford to accept. When we talk about land values moving in a certain direction in the future, it's important to understand where they are today. We know they're falling right now. We know they're at about $11,400 per acre. But is that value too high or too low? How do we know? Well, maybe you and I don't know, but we have experts in the land markets, in the ag sector, that respond to our land value survey. So we ask them this question. We ask them to rank or rate their perception of current land values. They let us know that within their counties, whether they think the land values are way too low, just right, too high or way too high. These county level responses are aggregated to each of the crop reporting districts, and then the statewide estimates that are in the top row over there in the chart. Now, the too high and way too high categories are the ones indicated by red and orange on that chart. And that is the dominant category chosen by our respondents this year. Most respondents believe that the land values within their areas are either too high or way too high. A few of them, a small fraction, also thinks that it's just right. When they say it's just right, it means sticking to the fundamentals. They see that return on investment. They think it's worth it to buy land at that price. But by far, most people are ranking it on the too high or way too high spectrum at the moment. Why do we care about how they're ranking it? Because these are the people who are advising their clients on whether to accept a certain price or not and how to move forward in the land markets. These are also the people who move the land markets by accepting or by creating predictions like these. We also ask them what their predictions for land values are 1 year from now and 5 years from now. And then blue bars over here show us their short term expectations, where they expect the land markets to move within 2025. The red bars show their expectations for the land values 5 years from when they filled out the survey in 2029. Most of the blue bars are on the left-hand side, indicating the drop in the land markets. Most people believe the land markets will fall further or land values will fall further by either a less than 5% drop or maybe a drop between 5 to 10%. There's also quite a few people who believe that they will remain the same, or some people also expect an increase. But when we zoom out enough, when we go back to the 5 year horizon, most people expect land values to make a recovery, land markets to go back up again, and experience increases of 5 to 10%. Or the biggest category that's chosen by most respondents is an increase of 10 to 20% 5 years from now. If we look at some other states, this is the same expectation question that is asked to producers in Indiana in the producer survey that the Purdue University does. Their expectations are a little different than ours. For them, more people expect higher farmland prices in the year to follow, 12 months ahead, compared to the people who expect farmland values to decrease. And these expectations are virtually unchanged from their previous survey 1 year from now. So, why is Indiana expecting higher land values while Iowa expects lower land values a year from now, or which is essentially 2025? What is different between these two states? We've talked about that just a little bit. But then their survey also includes a reason, allows respondents to choose what they expect, what is the major factor that they expect will influence the land markets in the next year. And one thing to note here is that alternative investments make up a very big category in their survey. That is the orange bar over here. Some of the other factors, net farm income, interest rates, inflation, our respondents also mentioned those things. But when we were looking at major factors, positive and negative, that affected the Iowa land markets, alternative investments was not the biggest one. For Indiana, it is so. A lot more respondents here, maybe 25 to 30%, believe that it's the alternative investments that keeping the value of land up, or in trust from outside investors, not farmers. Why is that? Currently, there's 13 states in the US that have some sort of farmland ownership restrictions. All of the blue ones here. And then the 4 orange states, they don't have ownership restrictions when it comes to farmland, but they do tax corporate owners or institutional owners a lot more than individual farmers, discouraging more formalized forms of ownership for farmland. So note that these blue states do not include Illinois or Indiana. What that means is when it comes to the blue states, Iowa is in the middle of that, and Iowa by far has the strictest restrictions there can be. These blue states do not really allow investors to be an active player when it comes to the farmland markets. But the other two, Indiana and Illinois here, which are gray, they allow investors. They have no restrictions on who can own farmland and who can be an investor in the farmland markets. That's why when the same question is posed to the respondents in Indiana, they are putting up alternative investments as a major reason that's affecting the farmland markets. But when the same question was asked to our respondents, the investor demand made up a very small portion. And for us, the investor demand was explained largely by the investment in recreational ground or hunting ground for some southern parts of the state. Another form of interest that comes for the land markets is the foreign interest. And let's take a quick look at where that stands in 2021, which is the most recent data year. On the left-hand side, we have the chart that maps the foreign interest for the entire US. On the right-hand side, we have the chart that shows us the numbers only for Iowa. So there are two types of interests that foreign entities can have in our farmland. There's an ownership interest, they can own the farm ground, or they can lease the cropland. On the US side of the map, these are divided neatly. The similar trend follows in Iowa, but it's not divided on the chart here. But expect about a similar trend for Iowa as well. Note that the owned cropland acres do not really change drastically. So when we hear all these things about foreign interest in US farmland picking up in the last 5, 6, 7 years, a lot of that is coming from leased cropland. In fact, almost all of that is coming from leased cropland acres. It's not really coming from other people buying farmland in the US for a number of reasons. In a lot of cases, it's not allowed, especially that's the case for Iowa as well. If you're a foreign corporate, then corporate restrictions also apply to you. And then the second reason that we don't really want to be concerned about it is, although it's an upward trend, I want to highlight the percentage I have on top of each point in the Iowa chart. That shows that this upward trend, what does it amount to out of all the Iowa land we have? In 2021, all of the foreign interest in Iowa farmland, including owned and leased acres, makes up about 1.68% of Iowa farmland. It's less than 2%. It's not big enough to really move the markets. There's not enough foreign interest in our markets to actually affect farmland values substantially. All of this information and then a lot more about farmland ownership and values you can find on the Iowa Farmland portal that's available at farmland.card.iastate.edu. With that, that's all from my side. Thank you for listening.